Looking back at 2025, it's no secret that the economy has changed for the worse in the last few years. Target, for instance, who once bragged about their bargain prices, a place where you could find a full-time wardrobe on a part-time budget, a store where middle-class moms and confused teens could be ambushed by a sitting president because it was seen as the pinnacle store for the middle class, now wants to be known for selling luxury makeup and artisanal $30 throw pillows and $45 tiny throwback radios. Many Targets, in fact, have dedicated a huge chunk of their stores to mini Ulta stores, selling luxury makeup that you can pick up alongside your kids' school supplies. Or take Las Vegas, a city that used to be known for value, for dollar beers and $5 plastic yard cups full of liquor that you could just walk on down the strip with. They are now charging $25 for cocktails at pretty much any bar that you go to. But the thing is, in 2025, these tactics have seemed to backfire on these companies. And they're getting increasingly negative attention for practices that seem like complete nonsense now in 2025. So, what the hell happened? How did these once loved institutions fall so far from grace? Well, for years now, many corporations, whether it's stores, restaurants, hospitality spots, and more, stopped trying to cater to folks in the middle class. Instead, they're trying to fish in a pond that is smaller, but where the fish were bigger. But lately, what we're seeing is that this trend may have run its course. Stores like Target have consistently reported missed earnings in 2025, and the short-lived Ulta store-in-a-store concept is ending next year after only 5 short years. And there's a whole industry now dedicated to dunking on Las Vegas in 2025. So the question becomes, why did these companies known for value bet the whole house on wealthy customers? And how much longer will this last? Since the Great Recession of 2008, the wealth gap didn't just widen, it became the equivalent of the wealth Grand Canyon. Almost all of the income gained since the Great Recession went to top income earners, and their share of wealth has exploded to disproportionate levels. While the very top earners benefited the most of any group, the above six-figure households also saw some pretty significant benefits. So the logic for corporations became pretty simple. Why cater to a stagnating or even shrinking middle class when the top income earners are coalescing all of the available expendable money in their pockets? From a purely cynical capitalistic standpoint, this strategy might make sense if you're a business analyst and you think purely short term and you forgot a volume economy and how it works. Wealthy consumers are less sensitive to inflation, they buy higher ticket items that boost revenue even if the units sold are low. They tend to stay loyal to premium brands, and their spending held up even during economic downturns. However, this is relatively short-term thinking, but the way that Wall Street companies cycle through CEOs means that short-term thinking has become the prevailing operating strategy for many. CEOs want to ensure big-time short-term gains before they move on to their next venture. So corporations restructure themselves around flashy, short-term margin and price, and not necessarily long-term health and volume. Target became Target, signaling their shift to a more high-end customer base, whom would spend more money without having to overly rely on discounts and sales in order to drive their purchasing decisions. They used to be a bargain-friendly place with a pretty nondescript look, a one-stop shop where all of the needs of the middle class, clothes and shoes for the family, home goods, and even groceries, could be found in one space at an affordable price. And now they're a place that wants to be Pottery Barn so bad it's almost criminal. Target carves out huge swaths of their stores to these curated, workshopped, cookie-cutter, and pre-planned displays that are meant to give the appearance of a luxury store. Or as luxury as an extremely prescriptive as-built and corporate planograms can be, because ultimately they make all of the stores look the exact same. And all that is topped off with dead-behind-the-eyes celebrities just smiling at you from the displays, eagerly awaiting you to spend money. Just look at these people. Monstrous. So Target started jacking prices and reining in the sales despite not fundamentally changing the quality, materials, or other aspects of their offerings. However, when the economy was good, people really didn't seem to mind that much. However, now, in an economy that's pretty bad, it's becoming unforgivable. Their sales are down, and while you could point to the CEO continuously sticking his foot in his mouth and effectively pissing off customers from all sides of the political spectrum, I think that oversimplifies the true downfall of Target, which is their insistence on pricing things similar to high-end stores, but effectively offering Old Navy or Walmart quality. And then doubling down on these tactics in 2025 by raising prices in such a laughably naked way that you can actually peel off price increase stickers showing a lower price that was effective mere months ago. It has been a pretty embarrassing year for Target. However, no entity has lost their way quite as bad as Las Vegas. Economists tend to say that Las Vegas is a good canary in the coal mine of a recession in the United States, because Las Vegas, in a lot of ways, is like the US economy in a small scale. It was one of the first cities to be hit hard and early in the 2008 recession, with many projects being canceled right before the entire market collapsed. So how does Las Vegas look now? Well, it's not great. Hotel occupancy is down, visitor counts are down, tourism for California, down. And while some of the tourism slump is unavoidable, a lot of it is self-imposed, because Vegas in the last several years has exploded in their prices, with cocktails and bars like the Cosmo Chandelier Bar going from $15 to $25 in just a few years, resort fees doubling in many cases, and bottles of water famously being charged at $26 a pop. You would think that Vegas casino companies are trying to lose customers. But the thing is, while many indicators are not great, actual gambling revenue is actually level. What this means is that high rollers, at least for now, are keeping Vegas afloat. This isn't an accident. It's a trend that's been happening pretty fast and hard for about 15 years. Vegas went from tchotchke and cheap, where drinks were offered at rock-bottom prices and the hotels usually had a bit of a hokey theme meant to appeal to tourists, but with killer room rates at like $20 per night on weeknights. Luxury places like the Bellagio were a bit of the exception rather than the rule. However, Vegas pulled in such insane volume of tourism that resort companies were thriving, and it necessitated the infrastructure of Vegas being completely overhauled to cater to millions of people walking the streets each year. However, this year, these wide pedestrian-friendly walkways are empty because Vegas isn't a value destination banking on volume. Instead, drinks are $30 after tip, and every casino is now aiming at the luxury market, where room rates are closer to $200 a night on the lower end along the Strip. Despite gaming revenue still being strong on the backs of sports betting and high rollers, casino operators do understand that gaming revenue is only half of the revenue equation, and the other indicators are very alarming. And they are attempting to make some really flaccid attempts at reversing course with short-term promotions like waiving resort fees. However, with these short-term solutions, it seems like they're simply hoping to ride out the uncertain economy before returning to the same formula that they've been trying to hammer in for the last decade or so, which is a focus on ultra-high-end appearance, celebrity restaurants and spaces, exclusive experiences like Formula One, overpriced shows at the Sphere, and luxury experiences like sports stadiums with tickets so overpriced that no middle-class tourist can ever afford to see the Raiders lose to yet another NFL team. But here's the problem. While the top income earners are incredibly valuable, they're also finite, and they're getting more so finite each year. The share of wealth held by the lower 90% of income earners keeps shrinking each year, and more keeps going to the very top. So the biggest number of people are increasingly facing a situation where even splurging a little bit on anything is going to come at a trade-off that is just too steep to justify. And only a handful of people can truly afford these business practices that cater to the wealthiest people. To put it another way, as the economy worsens and the wealth continues to be concentrated at the top, the number of fish in that smaller luxury pond that these companies insist on catering to will dwindle further and further, as maybe the upper middle class folks on the margins who might have swam in that smaller pond with the bigger fish are going to be increasingly pushed out and into the same pond as the true middle and lower middle class cohorts. And when it comes to the handful of fish left, while they will continue to spend more per purchase, they cannot physically buy enough volume to support the entire US economy. Even the wealthiest folks realistically only buy one car every 3 years or so. They will only go to Vegas maybe once or twice a year. They can only fit so much stuff into their large houses. It's a finite need for an even more finite audience. And for the rest of the fish in the bigger pond, the prices are just simply out of reach. When the middle and lower class can no longer afford to buy seasonal home decor annually, when they can't upgrade their phones when they want to, when they have to hold off on going on vacation, overall, when they rein back money on casual things and non-essential things, we start to see the dire headlines and the underwhelming quarterly reports that we're seeing in 2025. The bottom line is that companies spent the better part of 2 decades banking on the top income earners because it worked. There were still enough fish in that smaller pond to keep companies afloat. But now, as the water is starting to recede, more and more fish are being forced into the other pond, and the gap between the two is bigger than ever, which is leaving no reasonable hope for the fish in the one to join the big fish in the other. Companies that better cater to the needs of customers outside of the ultra-wealthy, those like Walmart or Costco or Aldi, have been reporting better earnings than their competitors that are are trying to bifurcate the audience and exclude certain brackets of income earners. If other companies and brands don't take the same approach, they'll have a really hard time in the next several years, because there's no signs that the economy is getting better. The real crisis isn't that consumers aren't spending because they don't want to, it's because fewer consumers are even able to, and companies that take a luxury price approach are exacerbating this issue even further by putting things even more out of reach for everyday consumers. Therefore, over the next few years, corporate success likely won't be defined by targeting the top income earners, but rather by rediscovering the 90% of consumers that these companies left behind 20 years ago.